Imagine this for a moment. You open your trading app, scroll through US stocks, and instead of seeing prices like $50, $100, or even more, you see a real American company trading at just $5 per share. $5. That's less than what many people spend on a coffee or a fast food meal. Now here's the real question. Why is it so cheap? Is it a hidden opportunity that Wall Street is ignoring, or is it a warning sign that most investors are afraid to touch? Because history shows us something very interesting. Some of today's biggest winners once traded at prices like this, while others completely wiped out investors. In this video, we're breaking down one US-based company whose stock is hovering around $5, and by the end of this video, you'll know whether this is a smart opportunity or a dangerous trap. Low-priced stocks have always attracted attention, especially from new investors. There's something exciting about the idea of owning more shares with very little money. But here's the truth most people don't talk about. Just because a stock is cheap doesn't mean the company is weak. And just because a stock is expensive doesn't mean it's strong. Price alone doesn't tell the full story. That's why today we're not chasing hype or rumors. We're taking a calm, honest look at a real US company whose stock is currently trading around $5. We'll look at what this company actually does, why its stock price fell to this level, and what could happen next. I'll also share the risks, because ignoring the risks is how most small investors lose money. This video is purely for education, not financial advice, but if you stay till the end, you'll walk away with a clear framework to decide whether a $5 US stock deserves your attention or not. When people hear the phrase US stocks under $5, most assume it's either a scam or companies on the edge of collapse. But the reality is very different. The US stock market is massive, and within it, there are dozens of legally listed companies trading below $5 for many different reasons. Some are early-stage businesses. Some were once much larger but fell out of favor. Others operate in niche industries that Wall Street doesn't fully understand yet. The low price doesn't automatically mean the company is finished. It often means the story is unfinished. What's interesting is that these sub-$5 stocks still trade on major US exchanges like NASDAQ and NYSE. That means they follow strict reporting rules, publish financial statements, and are visible to global investors. The problem is not legitimacy. The problem is uncertainty. Investors don't like uncertainty, and when confidence disappears, stock prices fall fast. That's how many real companies end up trading for the price of a fast food meal. Another reason these stocks stay cheap is market psychology. Large institutions usually avoid low-priced stocks because of volatility and risk. When big money stays away, prices struggle to rise. But that also means retail investors often discover these stocks first. Sometimes that early attention turns into momentum, especially if the company delivers even slightly better results than expected. Now, let me make this very clear. I'm not saying every cheap stock is a hidden gem. Many are cheap for good reasons. But the US market currently has multiple real companies trading under $5, operating in industries like energy, biotechnology, shipping, mining, and technology. And this is where things get interesting. For example, there is a US company involved in deep-sea mineral exploration, working on underwater resources that could become important for future energy and fertilizer demand. That company is Odyssey Marine Exploration, trading under the ticker OMEX, and it's been hovering well below $5. This is a highly speculative business, but it shows that even unusual industries exist at these price levels. Crown Electrokinetics, trading on NASDAQ under the ticker CRKN, has been priced under $5 mainly because the company is still in an early high-risk stage of its business. It generates limited and inconsistent revenue while spending heavily on research, development, and operations, which has led to ongoing losses and weak investor confidence. In addition, the need to raise capital has created concerns about share dilution, and delays in large commercial contracts have kept the market cautious. As a result, the stock price reflects uncertainty about execution and profitability rather than the size or ambition of the technology itself. In the biotechnology space, where risk and reward are both extreme, several US companies trade under $5 while developing drugs or medical treatments. A well-known example is Sorrento Therapeutics, ticker SRNE. These companies often have no steady profits yet. But a single successful trial or approval can completely change their future or destroy it. Energy is another area where low-priced U.S. stocks appear. Tupperware isn't energy, but companies like Camber Energy, ticker CEI, have traded under $5 due to volatility, debt issues, and shifting energy strategies. These stocks attract traders because energy prices can move fast, but they also carry serious risk. Even in technology, there are U.S. companies trading below $5. Some were once high-flying growth stocks but lost momentum due to competition or poor execution. Nokia, ticker NOK, has spent long periods trading under or around the $5 level despite being a globally recognized brand. That alone shows how price does not always reflect brand size or history. Now, why am I mentioning these companies in the middle of the video and not at the start? Because I want you to understand the lesson before the names. The lesson is simple. Cheap price is not the story. The business situation is. Each of these companies is under $5 for a different reason. Some are speculative, some are cyclical, some are struggling, and some are simply ignored. The real opportunity, if there is one, comes from identifying which of these companies can improve their situation. That improvement might come from better earnings, lower debt, new contracts, industry recovery, or strategic changes by management. When expectations are extremely low, even small progress can lead to massive stock moves. But the risk is always present. Many sub-$5 stocks dilute shareholders, fail to recover, or disappear entirely. That's why smart investors never bet big on one cheap stock. They treat them as high-risk positions, not guaranteed winners. So when you see U.S. stocks trading under $5, don't ask yourself how many shares you can buy. Ask yourself why the market is pricing the company this way, and what could realistically change in the future. So after looking at U.S. stocks trading under $5, one thing should be very clear by now: price alone means nothing. A low stock price is not a shortcut to easy money, and it's also not an automatic sign that a company is worthless. What it really represents is uncertainty. Companies like the ones we discussed are priced this way because the market is waiting for proof of growth, proof of execution, and proof that management can turn plans into real results. Stocks under $5 live in a high-risk, high-reward zone. They can surprise investors with sharp upside moves when expectations are low, but they can also disappoint just as quickly. That's why these stocks should never be approached with emotion or hype. Smart investors look beyond the price tag and focus on the business itself, the financial health, the industry, the risks, and most importantly, what could realistically change in the future. If you're a beginner, the biggest lesson here is simple. Don't chase cheap stocks just because they look affordable. And if you're more experienced, these stocks can sometimes offer opportunity, but only when treated as small, calculated positions, not all-in bets. Discipline matters more than price.